right now, the key to surviving the 2026 economy isn't, building faster or selling more.
Right.
It's actually about slowing down,
Right.
building less, and really prioritizing the foundation.
Welcome to today's deep dive. We are thrilled to have you sitting right here in the room with us as we look at the literal foundations of the American economy.
Housing and water infrastructure.
Exactly, housing and water.
And we have two incredibly rich sources on the table today for this. We're looking at some recent, highly detailed corporate earnings call transcripts from two massive players in these spaces.
Yeah.
First, we've got Core & Main, and we're unpacking their fiscal 2025 fourth quarter results.
Yeah.
They're an absolute titan in water infrastructure.
Wow, massive.
Right. And second, KB Home, breaking down their fiscal 2026 first quarter results. They are, of course, one of the largest residential home builders in the country.
So the mission for this deep dive is to really extract the signal from the noise here. We're going to uncover exactly how these massive companies are navigating a highly uncertain 2026 economic landscape.
By looking at these two distinct but deeply connected sectors, we're going to help you understand how businesses are pivoting to just ruthless efficiency and protecting their margins when sheer explosive growth just isn't an option anymore. Okay, let's unpack this.
Yeah, the overarching theme binding both of these companies together right now is macro uncertainty.
Yeah.
They are facing a highly cautious consumer base. And as a result of that, they're dealing with intense stock market skepticism. But the critical nuance, and this is key, is that their underlying fundamental profitability is actually quite solid.
Right. The businesses themselves are healthy.
Exactly.
Let's look at the numbers for KB Home to see that disconnect in action. So in the first quarter of 2026, they pulled in total revenues of $1.1 billion.
Huge.
Yeah. They posted earnings per share, or EPS, of 52 cents. And their net orders were actually up 3% year over year.
Which is 2,846 homes ordered.
Exactly. On paper, that looks like really solid growth. But then management actually went ahead and lowered their full year delivery guidance.
And that is the paradox of the current market landscape right there. You have a quantifiable beat on quarterly orders, but a highly cautious forward-looking outlook from the actual people running the daily operations of the business.
Yeah, and we need to examine why they lowered that guidance. And to be incredibly clear for you listening, we are simply impartially reporting what KB Home's management stated on their earnings call as their reasoning.
Right.
We are not endorsing this view, nor are we taking any political sides whatsoever. But management explicitly cited the conflict in the Middle East, which began in late February of that year, as a geopolitical event that just added a fresh layer of uncertainty.
Yeah.
They stated that this specific event began weighing on the consumer psyche in March, creating near-term pressure that caused their sales traffic to soften right at the end of the quarter.
Because, global geopolitical events eventually ripple all the way down to, a family deciding whether or not to sign a 30-year mortgage in suburban Texas. When consumer confidence shakes, discretionary spending freezes, and we see a very similar story of solid internal execution meeting a highly cautious external outlook over at Core & Main.
Yeah, let's look at their Q4 2025 numbers. So revenue came in at $1.581 billion. Now that's a 6.9% drop year over year, which was a slight miss of Wall Street's expectations.
Right.
But management noted this was partly just a calendar quirk. They had one less selling week in the quarter.
Okay.
Yeah, and their average daily net sales actually rose slightly, but the standout metric was their adjusted earnings per share. It came in at 52 cents, which was a massive beat compared to the analyst consensus, which was hovering around 33 to 48 cents.
So they're highly profitable, executing really well on their margins, but their 2026 guidance remained incredibly cautious.
Yeah.
They guided for $7.8 to $7.9 billion in sales, and they're assuming completely flat pricing across the entire year.
It's basically the macroeconomic equivalent of checking the weather before a long road trip.
Oh, I like that.
Yeah, like the car's engine, which in this case is the company's fundamental profitability, their margin discipline, their EPS, it's purring beautifully. But management is looking out the windshield and they see these dark macroeconomic and geopolitical clouds forming on the horizon. So even though the car is running great, they proactively tack the brakes on their forecasts.
Yeah.
They don't want to promise Wall Street 80 miles an hour when they might hit a storm.
What's fascinating here is how the market reacted to that proactive breaking. Core and main shares actually dipped 1.3% pre-market right after this release.
Wow.
Wall Street essentially ignored the massive EPS beat and laser focused on the slight top-line revenue miss and that conservative forward guidance.
They want the growth.
Exactly. Investors right now are heavily scrutinizing top-line predictability. They don't just want to know that a company is profitable today.
Right.
They want absolute certainty that revenue volume will keep growing tomorrow. And right now, neither housing nor water infrastructure can guarantee that top-line certainty.
Which brings us to a crucial strategic question.
Yeah.
I mean, if you're a CEO and your top line revenue is held hostage by things you literally cannot control, like geopolitical conflicts or fluctuating interest rates, what levers do you actually have left to pull?
You focus entirely on the mechanics of your own business.
Yeah.
You control how you build, how you sell, and how you operate. For KB Home, this means executing a radical pivot back to their core operational philosophy.
Which is?
They are deliberately shifting away from building spec homes, which are, inventory homes built speculatively before there is a buyer lined up.
Right.
And they're returning heavily to their built-to-order strategy, or BTO.
And the numbers on this shift show serious intent. They exited February with 68% of their sales being built to order.
Wow.
Yeah. And they're aggressively aiming to hit 70% or more in the second half of the year. They're intentionally slowing down their speculative inventory, starts to force this ratio upward.
And to understand why a builder would intentionally slow down construction, we have to look at the carrying costs associated with spec homes.
Okay.
When a builder constructs a house, hoping someone will buy it, they're taking on immense financial risk.
Sure.
If the market cools and that house sits empty, the builder is bleeding cash.
Yeah.
They're paying property taxes on the lot. They're paying interest on the construction loans. They're paying for landscaping and maintenance to keep it looking fresh.
Right. All the ongoing marketing costs, too.
Exactly. And eventually, to get that dead weight off of the balance sheet, they have to offer deep price cuts or really expensive mortgage rate buydowns.
And bypassing all those carrying costs is the real aha moment for the built-to-order strategy. KB Home revealed that built-to-order homes generate 300 to 500 basis points of incremental gross margin compared to inventory homes.
That's massive.
Yeah. To translate that out of financial jargon for you listening, that is an extra 3 to 5% in pure profit margin on every single house.
With BTO, the home is already sold before they even pour the foundation. So they lock in their margin on day one. And to make this work, they've totally revolutionized the speed of their process. They cut the build time of a BTO home from 5 months down to just 108 days.
108 days?
Yeah, but wait, with mortgage rates creeping up and bouncing around wildly day to day, isn't a built-to-order strategy incredibly risky for the builder?
How so?
Well, I mean, if a buyer signs a contract and then has to wait 108 days for the house to be built, what happens if their mortgage rate spikes in month 2 and suddenly they can't afford the house anymore? Doesn't the whole deal just fall apart?
It seems counterintuitive, I know, but if you map out the mortgage timeline, that 108-day build time is actually the solution to the rate problem.
Oh, really?
Yeah. Historically, building a custom home could take 8, 9, or even 10 months.
True.
In that old timeline, buyers were hugely exposed to macroeconomic rate volatility. A rate lock from a bank usually only lasts 60 to 90 days, but 108 days is roughly 3.5 months. That is fast enough that buyers can easily secure extended rate locks early in the process, sometimes before the framing even goes up.
Right.
It drastically minimizes the window of financial exposure.
So speed kills the rate risk.
Exactly.
But what about buyer regret? I mean, if the economy gets shaky, someone might just walk away from their deposit.
You'd think so.
Yet KB Home reported their lowest cancellation rate in 4 years this quarter. 4 years. To me, that speaks to a really powerful psychological mechanism.
Definitely.
When a buyer walks into a finished spec home, it's just a commodity. But when they sit down, pick their specific lot, choose their elevation, select the exact cabinets they want, they're baking their own identity into the property.
Oh, absolutely.
It's like the IKEA effect on a massive macroeconomic scale.
Yeah.
You value something far more because you helped build it. The emotional skin in the game makes them vastly less likely to cancel the contract.
And management explicitly calls this creating personal value. It is an incredible defense mechanism against cancellations. But the strategy only works if the people signing those contracts actually have the financial foundation to close the deal. And the data provided completely shatters the popular narrative of the tapped out, over-leveraged American consumer.
Yeah, the profile of the KB home buyer is incredibly robust. The average buyer financing through their joint venture, KBHS Home Loans, has a FICO score of 743.
Which is fantastic.
For context, anything above 740 is generally considered very good or prime credit. These are highly dependable borrowers. Their average household income is $133,000.
Right.
They are putting down an average of 16% as a down payment, which equates to over $72,000 in cash. And 11% of their deliveries in the first quarter were to all-cash buyers.
And over 80% of their buyers are utilizing that in-house KBHS mortgage service.
Wow.
That gives KB Home incredible visibility into the financial health of their pipeline and tight control over the final closing process. This is a highly qualified, well-capitalized demographic making very calculated decisions.
But what's fascinating is that KB Home's resilient high-income buyer is actually the exception right now.
Yeah, they really are.
Core & Main is looking at that exact same residential sector and seeing widespread weakness, which is forcing them to look for revenue in entirely different places. Core & Main acknowledged on their call that the residential housing market is currently their weakest end market in the near term. But they aren't panicking because they've successfully diversified into municipal and commercial tech.
Right. They are offsetting that residential weakness with municipal upgrades. For instance, they just announced a massive smart metering award, which management noted was the largest they've ever won.
And smart metering means they aren't just, dropping off a truckload of iron pipes at a construction site anymore.
No, not at all.
They're providing highly technical turnkey solutions for city water grids. This involves installing digital sensors, setting up the wireless Internet of Things data networks, and integrating real-time leak detection software so municipalities can track exactly where they're losing water and money.
It's a very high-margin, technology-driven service.
Here's where it gets really interesting, though. Hidden in this earnings call about municipal water infrastructure was a massive, unexpected growth driver: artificial intelligence.
If we connect this to the bigger picture, it completely redefines how we should view a traditional infrastructure company.
Yeah.
The reason a water pipe distributor cares about artificial intelligence comes down to data centers. To run the incredibly complex algorithms required for large language models, tech companies are building massive, hyperscale data centers packed with high-density GPUs.
And those GPUs generate an astronomical amount of heat.
Exactly.
Traditional HVAC air conditioning systems simply cannot move enough cold air fast enough to keep these concentrated servers from melting down. Air just doesn't have the thermal capacity.
Water, however, is vastly superior at absorbing and transferring heat. So the entire tech industry is shifting toward industrial-scale liquid cooling systems for these AI data centers. And who supplies the highly engineered, massive water infrastructure required to pump thousands of gallons of cooling water through a hyperscale server farm? Companies like Core & Main.
It's the ultimate picks and shovels play for the AI gold rush.
It really is.
While retail investors are fighting over semiconductor stocks, Core & Main is quietly building the water architecture that keeps those chips from catching fire.
Yeah.
And it perfectly illustrates the power of end market diversification. When the residential home building sector slows down, Core & Main leans into municipal smart meters and AI data center cooling. It protects their cash flow when the macro environment gets choppy.
Because margin protection is the ultimate goal here.
Right.
When revenue volume is challenged, the strongest defense is ruthless margin optimization. You have to squeeze every last drop of profit out of the business you are actually doing.
And both of these companies are executing masterclasses in cost control. Looking at KB Home, they aren't just relying on that built-to-order margin bump. They actively went into their supply chains and cut their direct construction costs by 8% year over year.
That's huge.
In an era where inflation has driven the cost of almost everything up, driving your physical building costs down by 8% is a massive operational victory.
Definitely.
They also made the tough call to reduce their corporate headcount by 10% year over year, basically aligning their overhead expenses with their new reality of slightly lower delivery volumes.
But the most powerful margin lever KB Home is pulling is geographical mix.
Okay, tell me about that.
They're expecting a significant margin lift in the second half of the year, specifically because of where they will be finishing and delivering homes. They've recently opened communities in Northern California that are finally coming online.
And the real estate numbers in Northern California are just staggering.
Oh, yeah.
The average selling prices, or ASPs, in these specific communities range from $1.2 million to over $2 million per home.
Unbelievable.
Right. When a corporation is structurally leaner, building faster, and experiencing lower construction costs across the board, and then they suddenly mix in a wave of multi-million-dollar deliveries, the gross margins for the entire company just get pulled upward.
And Core & Main is playing a very similar optimization game. They are relying on structural cost actions they took back in fiscal 2025 to carry them through this uncertain year.
Right.
They successfully posted a 50 basis point year-over-year improvement in their gross margins, bringing it up to 27.1%.
And a key part of managing those margins involves hyper-focusing on their raw material inputs. Management specifically noted they're carefully watching global resin prices, specifically PVC and HDPE.
Yes.
HDPE stands for high-density polyethylene, which is the heavy-duty industrial-strength plastic used for municipal water mains and sewer pipes.
And the underlying mechanism of how commodity prices affect a distributor like Core & Main is fascinating. If global prices for PVC and HDPE tick upward, it actually creates a financial upside for them.
Wait, explain the mechanics behind that, because to a lot of people, higher material costs sound like a bad thing.
Yeah, it comes down to how inventory works. Core & Main is a distributor. They have vast yards full of existing pipes and materials that they purchased yesterday at yesterday's cheaper prices.
Okay.
If the global market price for those plastics suddenly goes up today, Core & Main can immediately raise their selling prices to match the new market rate.
I see.
Because they're selling cheap inventory at new, higher prices, their profit margin spread widens significantly until they eventually have to restock their yards at the new higher costs.
They capture the spread.
Exactly.
So for you listening right now, why should you care about Northern California housing mixes, or the thermal capacity of water in data centers, or the inventory spread on global PVC resin?
Right. What's the takeaway?
Whether you are an investor, a manager, or just someone trying to understand where this broader economy is headed, the lesson here is profound. It's about controlling the controllables.
When top-line revenue is held hostage by shifting interest rates and macro uncertainty, you cannot force growth.
No.
The operators who survive and thrive are the ones who look inward. They improve their cycle times down to 108 days. They lean into their highest margin segments, whether that's built-to-order homes or liquid cooling systems. They refuse to chase unprofitable volume. They chase efficiency.
They batten down the hatches and make the ship watertight. Let's briefly recap what we've uncovered today. Both KB Home and Core & Main are looking straight into a cloudy, uncertain 2026.
Yeah.
But instead of chasing sheer volume just to satisfy Wall Street's addiction to endless revenue growth, they're strategically pulling back. They're making their businesses more predictable, and they're fiercely protecting their margins through operational rigor.
They're choosing to be highly disciplined, acknowledging that while the macro environment is totally out of their hands, their profitability is entirely within their control.
So what does this all mean? If foundational essential industries like housing and water infrastructure, the literal bedrock of our physical world, are intentionally slowing their production and prioritizing efficiency over top-line growth, what does this signal for the broader American economy?
It's a big question.
We have spent the last decade in an era defined by growth at all costs. Subsidized expansion, blitzscaling, chasing market share, regardless of underlying profitability. But if the companies that pour the concrete and lay the pipes are voluntarily tapping the brakes, are we witnessing the end of that growth era? Are we entering a new economic reality where leaner is officially better than bigger? It is something to mull over the next time you look at a city skyline. Remember, it's what's happening in the dirt, deep in the foundation, that tells the real story. Thank you so much for joining us for this deep dive. Keep questioning the world around you, look beneath the surface, and we will catch you next time.